Well, after the healthcare bill was pulled, the headline news was about as negative as could be. That's a few days ago, if you all remember. The bill was expected to boost the bargaining power of the GOP's proposed tax reform by reallocating about $1 trillion away from Obamacare. But meanwhile, there was growing conflict. And on this upcoming tax reform issue, namely the border adjustment tax, which is a very important component to the bill, and markets had gapped lower by about 0.8%, I'd say, then moved lower from there, but only for a very brief moment before rallying the rest of the day. And headline news remained negative throughout the day, and that does illustrate the importance of watching your stocks instead of the news. If any of your stops were hit, you could honor them, as you should always honor them, as markets could have sold off deeper after the opening bell, much as they did on days like September 9th of last year on seemingly relatively harmless news. Just one of the Fed heads was saying he's reiterating his hawkish stance. Not a big deal because he'd said that before, but nevertheless, the major averages gapped lower and then finished down about 2.5% on both the S&P and the NASDAQ composite. But as we wrote and always advised, that when you get some situations like this, like we got a few days ago, you should keep an eye out for things like the Wyckoff undercut and rally formation. Any of your names which you might have been stopped out on might have offered a low-risk buying or rebuying opportunity should such a pattern occur. And we identified a couple of these situations in some of the stocks on the focus list. But yesterday, at any rate, the major averages rallied, but on lower volume. A number of tech the juggernauts like Facebook and Baba, Netflix, etc. They closed at new highs, though the breakouts have been on below average volume for those three names, which is really the opposite of what you want to see on a breakout. Even Amazon, which had a very clean breakout, I think the volume was only a little bit above its 50-day moving average volume. So meanwhile, the S&P and the Dow industrials continue to lag. The bounce remains somewhat suspect, but of course be open to the possibilities of a market that baby steps higher on lower volume, as it's done many times before. And also expect headwinds from the Trump reform tax bill, because obviously we're going to hear about that in the coming days and weeks. And any internal issues and internal conflicts like this component that I mentioned earlier about the border adjustment tax, that obviously is liable to rattle markets, because this big Trump rally we've had is conditional on these reforms, especially the tax reform bill, being passed. Now, in terms of individual stock names, we've got a few that were advancing. Let's see, right now we have they were holding tight along their 10-day moving averages. MKSI, that's just up fractionally. Momo's doing well. It's up about 3%. And then another Chinese named JD, that's about break even. So at any rate, those are ones that you could watch for. Your risk is pretty low because of their formations. And one other stock that I wanted to mention before we go into the other part of our broadcast is NTES, which could have been sold yesterday on a tight stop at its 20-day exponential, though the low of its viable gap up day could also be used as a maximum selling guide. So in other words, where one puts their sell stop, as many of you know already, is wholly dependent on one's risk tolerance levels, and also as well on how individual stocks and general markets are faring. So in other words, you might have a more liberal stop if markets are doing fairly well and your stock's doing well, etc. But if you start to see some warning signs, some yellow flags, you might want to increase raise the level of your stop to make it a little bit tighter, to keep your losses a little more restrictive in such an environment, because as we all know, the markets and individual stocks do give clues. Although in these environments, I would look to your stocks first and the major indices afterwards. And with that, we can go into the other part of our broadcast.
What part would that be, Dr. Hay? The other part?
The other part, whatever you want to, whatever you want it to be.
Well,
we're very fluid in our broadcast, so let's see what the market takes.
Just some quick comments on the indexes. I notice you have the NASDAQ right back up to the highs, and it's a little bit stalling today. I don't know if volume is up today. Is volume up today? No, well, it's down just a pinch. It might pick up. I would watch this though, because this would be a logical area for this to back up and run into resistance. So, but again, it's really a matter of watching the individual stocks. Now, I thought Monday was a very bizarre day, because on Sunday the Dow futures are down 150 and the Nasdaq's down, I don't know, 38, 40, something like that, and they're bombing everything. So it looks like it's going to be a nasty, ugly day on Monday, right? And so what happens is they gap everything down, and you can see this, you know, the Nasdaq opens here, this little tick mark right there, and Nasdaq opens down, and then it just turns around, undercuts this low. Of course, you've already undercut these lows, and now it turns and rallies. Now you're back up at the highs, but notice you're churning a little bit. So I'm not necessarily that sanguine about the indexes, but also notice that now there was a context for Monday's action being a low, because you had already had the Dow was down 8 days in a row, and of course you hear all the pundits talking about how, oh, the market was down 8 days in a row. It hasn't done that in 6 years. But when they say the market, they're talking about the Dow, which is the headline number. But the reality is S&P had been down 7 out of 8 days by Monday morning. And of course, it gapped below the 50-day moving average. Right there, you can see the tick mark, which is where it opened up. And it gapped below there, so traded a little lower and then turned around and rallied. And now you're back up in here. But the reality is you're still, if you're going by lower lows and lower highs, so far you're still in the downtrend. So you haven't really broken out of this. So, you know, you're still in a position where you could roll back. And it wouldn't surprise me if we saw the indexes just do this for a period of time as this Trump agenda gets sorted out and they figure out, you know, what's going on. So it could be very choppy on the indexes, and that could drive you nuts. And then as far as stocks go, I think it's half a dozen of one and 6 of the other. Some stocks are acting very well, and then some stocks are just kind of chopping around within their patterns. I think, like you were talking about Amazon, Dr. K, and that's a clean breakout. But personally, I don't buy breakouts anymore. I think they're high risk. You had to buy it here at the 50-day line on Monday, okay? And if you did, then maybe you could have bought it here at the 20-day line, the 10-day. And then you'd be in. That's where I prefer to buy. But on a day like Monday, it's very hard to step in when you see everything gap down. And the whole thing struck me as just a manipulation, because there wasn't really heavy volume selling on that day. Hold on one sec.
Yeah, actually, I wanted to just say the volume I mentioned earlier, I was looking at the log-based volume, and on the tick marks, it didn't look like very much, but on the linear, it was actually 42%. So I take back that, you know, the volume was not sufficient. It was actually, you know, very strong volume for a stock like Amazon, which is a super cap. But anyway, yeah, we're not buying breakouts in this market, as you all know.
Yeah, so now you have a break. I mean, that's constructive, I suppose. And the weekly chart looks like this. So it's a big cup with handle. And you can see that it looks like it's breaking out. So, you know, if you like buying breakouts, I guess you could say this is within 40, what would this be, like 43 points would be more than 5%. So I guess you're within buying range of it, since it's only about 12 bucks or so above the breakout point. So anyways, let's see. I'm trying to pull up our focus list. Let's see. And let's see, we look at some of these other ones. So BABA, for example, that keeps moving higher. It zigzags its way higher, and buying into strength on this one is not really the way you want to go. You want to buy on pullback. So you can see the pullbacks into the 20-day line here, and I guess the 10-day line here, but it's really buyable down in here. And once you're in and you're sitting with it, it's moving higher. So it's acting okay, but I would say it's kind of extended. This is what it looks like on the weekly chart. So it's moving to the highs of the base, so it could end up going sideways around here and maybe trying to go higher later on. So anyways, somebody asked a question. Case in point about breakouts. See Netflix's pullback after today's breakout. Yeah, and I wouldn't call that a breakout. That's like, you have one failed breakout here, and it fails, and boom, and now you're basically coming in, you're wedging back up to the highs. And you notice this looks a lot like the NASDAQ. So to me, this looks suspicious, and I wouldn't be buying the stock here. Certainly not extended like this. You had to buy it at the 58 if you were going to buy it. And like I said, on Monday that might have been a little difficult to do when things look like they're coming apart. And there's certainly a rationale for the sell-off, which is that the Trump administration's legislative agenda is in jeopardy. So anyways,
also, just so people know, breakout is just a generic term. It's like pocket pivot. There's different quality breakouts. Breakouts just mean the stock closed at new highs. It doesn't mean that it's a good breakout, or, I mean, as you all know, we're waiting for pullbacks to lower our risk levels. So obviously something like Netflix breakout would not even be a quality breakout in a better breakout environment.
Right. You have this Chamois. This one actually was buyable along the 20-day line, and it's broken out on decent volume. So again, that's a breakout, but I think you're better off buying it on weakness into the 20-day line. Now we'll see what happens, but it's acting pretty well. Coherent's another one that recently broke out, and these have been acting pretty well. That's a decent volume breakout 4 days ago, right here. So yeah, these names are acting okay, but we put this on our list down here, and you had one viable pullback into the 20-day line, and now it's out of here. So there are right places to buy these and wrong places in my view. And if you're buying them on the breakouts, you're just another animal running at the back of the herd, assuming you're even running. Maybe you're crawling at the back of the herd. But that's not really the way we operate anymore. Facebook just keeps trundling higher along the 10-day line, so it's not really violating, and certainly isn't breaking the 20-day exponential moving average. So that's acting fine, and unless it started to bust the 20-day on heavy volume, then the trend seems to remain intact. It's just marching higher though, and the volume is not all that heavy. And something to note here, maybe these are subtle clues. You put one and one and one together here, but notice how as you're going up here, the volume is light, okay? And then you pick up volume last week, and that was a big churning week. So the question is that telling you that it's running into some distribution up here, so it's ready for a pullback? Maybe it is, maybe it isn't, but it seems to me like it could be running out of gas, so I certainly wouldn't be buying it here. If I owned it, I wouldn't be selling it. Probably I'd be using the 20-day exponential moving average up here as a selling guide, a maximum selling guide, or the 50-day, which is pretty far up there anyways, 135.56. But remember, we put this thing on our list down here when it had these pocket pivots. Nice pocket pivot. It's a roundabout pocket pivot, rounding out the new base, breaks out, and then you get a nice pocket pivot here, pulls in. Again, if you see a pocket pivot, you don't just jump on it. And you can see here how you had the pocket pivot here, and then you get the pullback on lighter volume over the next 2 days. That would be your better entry point. So basically what you're doing is buying strength on weakness. So you see the strong move is a strong indicator for the stock, but then you get a nice low volume pullback, and that's where you try to enter rather than chasing the strength. I mean, if you're running around in this market chasing strength, you run the risk of getting run in, or run out, shall we say. And that is because this market tends to be volatile. Things run up and they come back in, and Facebook has been no different than most of those. So let's see here. The green plants you're seeing on my screen from time to time are not, it's not marijuana, just so you know. That's actually California wild sage, which is down in the marsh just below my house. and you go down there and you just see this beautiful green sage everywhere, and the fragrance is amazing. So I thought I'd take a picture because I thought it looked pretty interesting. In any case, let's look at JD.com, holding tight along the 10-day line. But I don't know if I think you had to buy this last week on the undercut and rally. So you undercut this prior low here, and then you turn and rallied, and you move back to the highs. Then I would sell this and just let it see if it sets up again. So that's how I would handle that. But that's an example of using the undercut and rally, also known as the Wyckoff Spring, as an entry point. The MKSI, it's holding tight along the 10-day line, so it's acting okay. I guess if you like this one a lot, you'd buy it on pullbacks of the 20-day or the 50-day moving averages. And then Momo, of course, moving up, they're hanging tight, so that's kind of extended. You're not going to jump on that one. Netflix we talked about. NetEase is questionable. But again, this thing's just been in a base. If you look at this, it's had a big move. So you can see that it's been going higher for quite a while. And so this is a late stage breakout here. You could consider it that. So it's prone to failure, I think, so it could fail. But so far it's just kind of showing a lot of weak action. If you look at this, you have the Bible gap up here. It runs up a little bit, fails at the 300 level. And then when that happens, I'll use Livermore's century mark rule in reverse. So you short it on rallies up into 300 on the break below 300, and that's actually worked for short-term tactical shorts. But now it's coming below the 20-day line. Volume picked up yesterday, so it looks like a test of the 50-day line, or at least the 278.80 low of the Bible gap up is in store here. So, but again, a stock, the place to buy this one, where was the place to buy this one? Well, on the roundabout. So here's your roundabout pocket pivot, people, right here. Boom. Big volume, pocket pivot coming up to the 10-day and the 20-day. That's a roundabout pocket pivot as it's forming a new base. So there's another entry point. And I think there were some more entry points in here. Pocket pivot, I believe here would have been right here. So you get all these early entry points. And if you know how to use them, this is where you're buying. Okay. In my view, people buying breakouts are idiots. Or they're just incredibly slow, and they've been indoctrinated by all of the IBD baloney, most of which is baloney, and I'll get this a really good example of what's some baloney in a little bit here. But there's better places to buy these things and earlier spots to enter. So if you're coming in on strength and buying them up, then the chances that you're going to get run out are higher. So, and the other thing is this market gives you a lot of chances to buy things on weakness and on roundabout formations. Stocks have built bases, pulled back, built normal bases, and now they're coming up and forming the lows of the base. We got into a lot of detail on this a couple of weekends ago at our mini conference. So Quantenna. Oh, this is a thin stock lover's name, but look at this thing. I mean, this is so typical for this market. We put it on first here. You had a nice move. Okay, what is that? What is that, Dr. K? Like 25% in 4 days?
Yeah.
Yeah, okay, so then you sell into that. Now here it comes all the way back, right back to the starting point. You buy it back. Boom, it runs up, another 25%, and takes a little bit longer, but it runs up, starts to falter, sets up again, and then boom, we get another run. What is that, 20% in 2 days?
Yeah, I mean, it's just got to take money and run.
Yeah,
every
and
time
boom,
do
they nailed it. And then it gets nailed here, and it's back to the 59. Now it almost looks like it's going to die, now that it's got everybody all excited about it. But see, this is where IBD would be telling you, oh, it's a cup with handle breakout. Yeah, okay, great. So you buy it up here. Or wait, you can't buy it unless it's within 5% of the buy point. Don't ask me where that rule comes from, because that's extremely arbitrary. My view is you buy it as close to the buy point or an area of prior support, such as the moving averages, like here and here and here, rather than jumping on a buy point and trying to figure out if it's 5% pass, or jumping on a breakout, rather, and trying to figure out whether it's 5% past this level here or this level here, and therefore in, quote, buying range. which is another bunch of BS that you get fed by the IBD types. And I know there may be some new people on the webinars who've seen a big jump in subscribers recently, which I'm not sure whether that's a bearish sign or not, because suddenly everybody's interested in the market. And you see the subscribers ebb and flow as the market gets better and not so good, and better, not so good. And so it's kind of interesting as an indicator. Someday we may have to set that up as some sort of indicator. In any case, Cena is acting okay. It had a couple of pocket pivots. You can see these right here. There's one here, one here. There's the volume. You can see 2 pocket pivots over the last 5 days, but they don't really go anywhere. So you want to buy it on weakness coming into the 20-day and 10-day moving averages. So no need to get excited on the upside. Snap had a nice move on the pocket pivot, but now it's pulling into the 10-day line. I'd be careful with this one. It may need more time to set up, and you got your move because you had to get a 20% move. On this one, I was actually buying it. Here's a prior low, 2064, but notice how it makes this low, it rallies and then pulls back, volume dries up, and then boom, it turns and goes. So I'll buy, this is a Wyckofffian retest, which is where it pulls back towards the low, but the volume dries up. And once it turns, you can come after it. You got to be quick, though, and you got to be alert in case it fails. And then the next day, we get the move back up through this 2064 low, which becomes a new buy point. And then by the time you got the pocket pivot, it's already up another 5% or more. And you get 20-something% out of this. If you bought the Wyckofffian pullback here, or retest, you got 25% out of it in just a few days. And in this market, I'll take it. Okay, now, and you know, meanwhile, the IBD readers are all waiting for a new high breakout through here. So all I have to say is keep waiting. Meanwhile, I can make 25% on this stock, which is something that IBD tells you to take 20 to 25% profits on breakouts when you get them. Of course, the only problem is that in this market, you rarely get those. So you've got to have better entries to get those kind of moves. Whoops. Let's go to Tesla, gapping up to the highs here. This was, we had a pocket pivot here, then it fails. Then you turn. And this is a moving average undercut and rally type of setup that I use now. If something undercuts a moving average, I will come into it if it turns back above. Because basically it fakes everybody out here. And I'll come back into it. And they've actually had some positive news flows. I know Tencent Holdings announced that they bought a 5% position, which actually works out pretty well for Tesla because they get more cash. And one of the things that the shorts have been bandying about as an issue for the company has been the fact that they're going to run out of cash. But they successfully executed a secondary stock and bond offering a couple of weeks ago. And now they're getting money coming in from Tencent Holdings, so that's helping them out. So not, you know, they're looking okay. And stocks, you know, you got a gap up here. It's holding. It's not a viable gap up, right, Dr. K? But why is that?
Not enough. You know, viable gap ups, you have to have a definitive jump in price relative to the stock chart. So you can just develop a chart eye in terms of, you know, instead of getting bogged down by percentages and whatnot. You just develop your chart out to where you can see, okay, that's clearly a viable gap up. And of course, this one clearly isn't. So, you know, again, we talk about it in our book, and I think we mentioned some hard percentages depending on whether it's a bigger cap or a smaller cap name. But I think all traders should just strive to develop the chart eye so they don't have to fall back on hard percentages.
Yeah, and the other thing to think about here is it's not really breaking out. So you've got some resistance from the left side of the pattern. So this could be a near-term top where you pull back and now you got to set up again. And I guess we'll just see. But it's been a pretty good stock so far this year. And again, you know, if you're awake to this kind of stuff, you can actually see that the stock had a number of bottom fishing and roundabout pocket pivots. Here's one pocket pivot here, boom. And then here's another one here, boom. And then here's 1, 2, and 3 pocket pivots way down below the 230, 220 level back in late December, early January, where you could have been buying the stock, okay? And if you did, you'd be making money because it's continued higher. Now, if you're an IBD type person, you're basically, you're sitting around waiting for some kind of breakout. I don't know where exactly, and you're not participating in any move. And meanwhile, the stock's having a big move, and you can see that on the weekly chart here. So, this market requires a little bit different way of thinking about things, and I'm just amazed at all the robots who, they go to an IBD workshop and they learn to buy breakouts and all this other BS, and it really doesn't work in this market. So TTD, the trade desk, testing the 50-day line. That thing had a big move though, so in my view this needs more time. I definitely would have been selling somewhere in here, and now it probably needs more time to form a base, assuming that's what it's going to do. And last but not least, Viva Systems. That's extended, so you're not going to buy that. Now, a few people were tweeting at me and emailing us about high type. Applied optoelectronics is a high type flag, and I have to tell you, it makes me laugh when I hear people talk about this, because when Bill O'Neill wrote his books, the one example of a high type flag was Syntex, and that was it. Back in the 60s, which was a go-go market, and it was a very strong bull market, and he talks about this pattern as being something. So of course here you have it on the weekly chart. So it's allegedly this is a high tide flag. Now let's get real here first of all, and let's note that applied optoelectronics, if you know how to handle viable gap ups, and you don't need us to put out a report. If you learn our methods, you can see things for yourself, and so you can capitalize on something that's occurring in real time, even though we're not necessarily putting a report out on it. But here you had a viable gap up. So it opens up, it sets a low here, and you could have been buying it. And then you had pocket pivot, I believe, right here, and then another gap up move that could have been bought, and it's just another viable gap up here. So you could have been in this stock a long time ago, and you even have pocket pivots like here in the pattern where you could have been buying in. If you go through, you might find a few others. But also low volume pullbacks, get an undercut and rally move here. So there's all sorts of spots where you can buy this stock. Now you've got people talking about that this qualifies, and I gotta tell you, it just makes me, what is it, LFMAO? Because what does that mean? It qualifies as a high tide flag. What does that mean? You just buy the thing now, and it's going to magically have like 100% move from here after it's already gone up 3 times from the first buy point that I pointed out down here? Are you kidding me? So again, this is a sort of dogma that you just identify a chart pattern, and it means that it's going to lead to huge gains. And you can see the stock now has come right back in. If this is your breakout point, guess what? It just failed. Happy birthday. And so if you're an idiot buying this on the basis of it being a high tide flag, or you think it has to qualify, which I don't even know what the hell that means. It qualifies as a high tide flag. What I'm going to do, mortgage my house now and throw everything into it. Can anybody explain this way of thinking to me? I don't understand it, but this is the kind of dogma and baloney that IBD puts into people's heads. And meanwhile, you probably, if you use typical breakout buying methods, you probably can't figure out that you can buy these Bible gap ups, especially this one here, even though they might tell you it's 5% extended past the breakout point. So, there's just better ways to operate, people. And I think the more we can spread the word on this through our websites, our books, and most recently our mini conference, the better, I think, and it gives people more tools so they don't get tooled with, if you know what I mean. Anyways, somebody asked a question: to what extent, if any, do you incorporate stochastics into your buy-sell decisions? None. What is that? Uh-oh. We have a rogue. LOL, that's funny. That's coming through a website. It's actually the investors.com website. Time to shut that one down. Okay. Anyway, someone's asking, to what extent, if any, do you incorporate stochastics in your buy-sell decisions? I don't. Also, bongos and force index. Well, if you know anything about how I use HGS Investor, I use it. I have a code blue type of thing on my charts that I use, and when something's basing and sets up in code blue, I will oftentimes buy on that basis. If something's really tight, and showing me, so like for example, let me pull up something better here. What would be a good example? Here's Momo, okay, right here. You can see as it's rounding, you get a pocket pivot here, and you're going all blue here. You had a pocket pivot down in here, I believe, and you started to show some blue and a kahuna here. So there's a lot of different things, but there's nothing concrete. There's no formula. That's the other thing with people that amaze me. They think there's some sort of formula. Like some guy was emailing us the other day and had a million questions on how I trade. How many positions do I hold? How long do I hold them for? Why is it relevant? I hold them for 5 seconds, 5 minutes, 5 days. I don't know. There's no formula, but everybody wants to believe there's some magic formula you can follow without having to think. So that will send you back to the back of the classroom or the back of the herd. Anyways, Paul, that's what I use, and it's somewhat useful. But again, you really have to be able to get a sense of what stocks are doing on your screen and how they're moving about. Now notice, I'm just looking at my screen, speaking of looking at screens, and Weibo had this range breakout pocket pivot. Now, I don't know if maybe this is a one-day wonder move, It came up off the lows here, tested this low. There's no undercut, so unless you call this an undercut of this low here, which is a possibility. But it did undercut the moving average and rally back above it here on Monday, so I guess that was when it could have been played if you're really alert to it. And then you get this pocket pivot breakout here to the top of the range. Now you're pulling back into the tops, and I'm wondering if that's actually going to hold up or not. I don't know. That's hard to figure. But that's interesting that it's coming back to life, sort of, as just as we see, Nettie's getting into some trouble. JD's acting okay. So these are the Chinese stocks I've been following. What is Tencent, Dr. TCEHY? Yeah, that's moving higher. That's actually acting okay. Let's see what it's a recent cup with handle breakout, but I wouldn't be buying it up here. And like I said earlier, don't be surprised if the market pulls back in here. It looks to me like from an index point of view, it's possible that it could. So, what else? Do you have any guidelines for action surrounding secondary stock offerings? Like, okay, did I just talk about formulas? There are no formulas for handling things. If you have a secondary stock offering and the stock absorbs it pretty well and rallies, I might buy into that. But there's no one-size-fits-all approach, or some formula. So looking at ELF, it sold off after earnings and secondary appears. So let's look at this. So you can contrast, I guess where was the secondary? Up here, and that just got booted. But if you look at Tesla, they announced a secondary, and they posted a pocket pivot. Go figure. So you really can't. There's no formula like if a secondary is issued, then wait 2 days and buy stock 10% lower. That's not how we operate. You watch and see how the stock reacts to the secondary. If it's constructive and it absorbs all of the new supply pretty well, then I think you could jump in on it. And sometimes I will wait for a stock to come out with a secondary if one is announced and it sells off, and then look for the next new entry point. So the Dow's up 30. What was the peak here? Didn't we get up like 80 something? One thing I noticed is the whole time the Dow's going higher, this UVXY creature, which I think is just hilarious to watch because it's so bizarre. It's been up all day long even as the market's rallying. So does that mean it's going to go down if the market sells off, or that it's going to go up more? I don't know.
There's no yes or no to that.
Is there a no or yes?
It all depends on many factors involved.
Any approaches for locating?
UXY into any kind. All these volatility instruments that are dependent on a lot of different things.
Yeah. Somebody's asking a question. Any approaches for locating double bottoms and inverse head and shoulders? Well, if you were listening to what I've just been talking about using alternative buy points, such as an undercut and rally, which is actually can be looked at as a double bottom. Let me give you an example here. Look at this box here. Now I remember watching this thing, and I noticed how it formed this pattern here. You see that? Then there's double bottom, and it undercuts this low here. So right here, it undercuts this low over here. Okay. So what is that? That's an undercut and rally. That's a Wyckoff spring, and it's a double bottom. So there it is. Bingo. It's in your face. You could have been buying this stock right there. And I actually thought about doing that, but it's kind of thin, and so not really a big enough trader, even though it trades 1 million shares, but it's on like 15 million in dollar volume, so it's a little bit scarce. The Dow's up 16 now. We're going to reverse here, just like I thought. In any case, that's you go around and you look at the stocks. Now, one thing I do, okay, if I have a long watch list, but I actually date my watch list. So I have one that's a current one, probably dated 3/22, but I also have one from January and one from December last year, November, October, and going back. And even though stocks will come off my watch list, I usually renew my watch list and I save my old ones. And I'll go back and look at old chart patterns. So let's say, for example, that I had Box on the way up here. It had a nice move. I had Box on my long watch list, and then it started to break down, and I sold it, and then it's off of my long watch list for now. But it's on. I'm keeping it on an older dated watch list, and I'll go back and look at these patterns from time to time. And sometimes I might notice, as I did in this case, that the stock could be forming a double bottom. When I see it undercutting the prior low in the pattern, now I'm alert to the fact that it might set up as a double bottom, and right here it becomes an undercut and rally buy setup. So also known as a Wyckoff spring. And I would suggest going and reading all of the Wyckoff books, the ones written by Richard D. Wyckoff, W-Y-C-K-O-F-F, for all you newbies. And also anybody who's written a book about Wyckoff, like there's one, I'm trying to remember the name of the guy, but it's Trades About to Happen. And that's a great book in terms of identifying all the different Wyckoff techniques. There's also another one called, I think, Charting the Wyckoff Method or something like that. But I would check those out because you'll learn about buy setups that are not breakouts, and they'll lead you to picking stocks off, in the lows of base patterns. But one of the ways I identify potential bases that might be forming, and then I'll be on the lookout for buy points that are down in the bottoms of the base. The same thing goes with something like Momo, for example, which, okay, as it's rounding out here, it's forming. Maybe it's been on my buy list. It was on my buy list earlier, and then once it's sold off here in reverse on the breakout attempt, it's off of my current watch list, but it stays on an old watch list. And I remember going through my old watch list at the end of the year, and I noticed this one was coming around and it looked like it could be forming a low of a new base, and it's logical for it to form a new base. And one thing I noticed is along the lows, the volume is drying up. You can see that down there. It's really dry. And so once it starts to turn, I notice you get a bounce off the 200-day moving average. Here, it runs up, and then it rolls back. Let me clean this up. And it rolls back, okay? And as it rolls back, it doesn't quite get to the 200-day line or the prior low, and volume is really light right here. So what is that? That's a Wyckoff-ian retest. So that's actually a buy point. So it turns back above. You get a pocket pivot a few days later, I think through the 50-day line here, and it's off to the races. And you're in the stock there. So that's one way of identifying the lows of a new base. And the best way to do that is maintain. So just because you have a buy watch list and a stock comes off, put it on old buy watch list names or whatever lists that you create, okay? So these are names that had previously been on your watch list. You took them off for, they had a failure like Momo did up here. And you go back every couple of weeks and you go and look at that list and see where some of these prior leading stocks might be forming new bases and showing buy points such as a Wyckoff-ian retest or a roundabout pocket pivot as it rounds out the new base. They might be showing these new buy points a lot earlier than coming after the breakout. And even with Momo, this was your breakout here, but you couldn't buy it, I don't think, because it's 5% extended from here. But it's a buyable gap up, so we know we can buy it. But you could also have been in the stock down in here. There's a number of pocket pivots all the way up. So that's the best way to do it. So I hope that helps answer your question, Joe. Let's see. Market up 22. Somebody asked, maybe you can answer this, Dr. Hay, why is ZIV up and XIV down over 1%? Shouldn't they move in the same direction? And that's actually coming from Dr. Allen, who was at the conference. It's good to see you there, Dr. Webb.
If you look at, you don't expect one-to-one correlations, but there is definite correlations. If you look at a daily, for instance, of ZIV against XIV, you'll see that there's a high degree, obviously, of a correlation between these. ZIV is like XIV a 1x. And I think there's also a half X, ZVX, I think, or ZXV, something like that. But anyway, now you'll get some minor discrepancies along the way. I wouldn't try to arbitrage because you don't know which way the market's going to go. So one could catch up to the other. But in general, one will catch up to the other, but you just don't know in which direction.
Let's see. Someone's pointing out David Weiss wrote the book Trades About to Happen. Yeah.
I can't hear your mic is.
Someone's pointing out that the book Trades About to Happen was written by David Weiss. Yes, thank you for that. Once a stock is sold, does it remain on your current buy watch list, or do you add it to a sold watch list? Well, if the stock breaks, just because I sell it, I'm not going to take it off my buy watch list because it may just be a short-term, like with the snap. I played that move. I got that nice move off the 1920 area and sold into that, and now looked at buying it back in here. But it's a little, I don't know, I think it needs more time probably. But if there's something that breaks down entirely, like I showed you the Momo did back last year, so it was coming up, it was actually acting pretty well. We had it on our watch list, and then it failed here, so that was where it came off of my long watch list because it's basically a failure. Now it actually becomes a short, so it could have been shorted up here. You could have made some coin there. But again, all that leads to is the new base forming, and so this was on my old watch list, an old watch list I think dated from December or November, I forget. So anyways, on an index basis, this market is very choppy. It's all over the place. I think stocks are all over the place. It makes it very difficult. So.
Oh, by the way, that I mentioned that 0.5. That is ZIV. I think that is the
ZIV.
A lot slowly than XIV. Yeah, just an aside there. But you can always take a look at what volatility ETFs are out there just by googling those terms, and you can pull up all the whole family of these things. I think new ones come out every now and then as well, but the most liquid ones are things like XIV for the 1X, and let's see, SVX. Y is another one that's very liquid.
Anyways, let's see any other good questions here. Looking around, I don't know. I'm a little wary of this market here. I'd let it pull back. I'd want to see some fresher setups. A lot of things have been bopping around. Here's Splunk. Had a pocket pivot yesterday, but one thing you got to watch out for, okay, if you're seeing pocket pivots, remember I showed you the Weibo earlier, and that had a nice pocket pivot, but if you see strength one day and then the thing fails, I'd be shorting it at the 50-day line if that happened. But if you start seeing that in a lot of names, then that's probably an issue. So let's look at, what was the other one I just had pulled up here? I forgot already. Oh yeah, Splunk. Here we go. You had a pocket pivot yesterday. See that? Here's the pocket pivot volume, higher than any down volume over the prior 10 days. And you're coming up through the 10 and the 20-day moving average, and it looks pretty good. You're coming up to these highs, but you're stalling today. So if you see heavier volume and the thing blows through the 50-day line, that could become a short. So a lot of times in this market, you'll see strength one day, and it doesn't really take you anywhere. There are some outliers, that where you'll see strength follow through. Momo is a good example of one recently, but that's gotten extended. But these other ones, like the Splunk, this could be a situation where, and Weibo as well, where you see one day of strong action and then it just rolls. And if you start seeing that, then we probably got a better pullback coming into play here, and that's something to watch out for. So. Anyways, any questions? Any other questions before I sign off? I'd like to get back to trading if this thing reverses. You got anything to add, Dr. K? Any brilliant insights?
No, I think we're good here. You know, the market's kind of still in a little tentative, but you know, keep an eye on your stocks. Things are looking a little bit better, but you know, any day there could be some of these Trump-related headwinds. So, you know, like you were saying earlier, you know, the S&P rather, it had a what 7 or 8 week sideways move from December into January.
Yeah, this
and right, there's a lot of issues out there that might keep at least the S&P and the Dow in some sort of a basing pattern until some of these things are worked out in either direction.
So you could chop around, but the other thing to keep in mind, it's like I pointed out earlier, is that the S&P is in a downtrend. Actually, it's about a 3-4 week downtrend. Well, let's say 4 week, and it could be starting to roll over. So you know, I would be cautious here, and I wouldn't be getting really aggressive with new positions. If you have things that are working, then just know where your out points are. So, you know, for example, if you're long the Facebook or anything else that's working, the Momo, just know where your out point is. So for Facebook, like I said, you know, the 20-day, or you could use the 50-day. I guess, what would you use here, Dr. K, based on the 7-week rule, the 10-day or the 50-day on Facebook?
Oh, it looks to me like it hasn't, well, it violated it 7 weeks out, after 7 weeks. So
you'd use
basically you would switch, you know, wait, hold on a second. Yeah, I mean, you could have sold it on that violation, or because it did it looks like on the 8th week. But on the other hand, I mean, it's acting fine. I would probably stick to using the 10 days just to keep it tight. But then it's market contextual as well. I mean, if this thing were to head back down below the 20, I don't think I'd be waiting for the 50-day, because that sort of implies that something's not all well with the general market.
So okay, so where would you put your stop then exactly?
Well, right now, given, of course, everyone should know that stops will be adjusted, you know, depending on how the markets are doing and your individual stocks are doing. So right now, I would keep it pretty tight and look for a violation of the 10-day. So if it repeated what it did on the 22nd, where it violated the 10-day, that's where my stop would be. But again, you know, that could change. So when you put your stops in, don't assume that that's going to be your stop when you actually sell the stock, because if you know, every day, with each passing day, conditions do change. So you're going to want to adjust your stops accordingly. But what I like about also, you know, if you have a lot of positions on, or more recently, like say several weeks ago, and the markets were in a good position, and our focus list, the number of names on that expanded to about, what, 24 names or so. Yeah. You should always know your exit points at the start of every day, so you know you won't lose any sleep, because you'll know exactly where you're going to be out of your position. So even if you're worried, oh, the markets are looking very fragile, you still know where you're going to get out of your position. So that's psychologically trading from a point of strength, because there's no question mark in terms of, you know, well, where's my out point, or how much money am I going to lose? You know how much money you could potentially lose given the worst case scenario. That would be all your stops getting triggered. And if you can live with that, then you're in good shape.
Someone is asking, is the goose ready to fly? I don't know. It's a little bit like Snap. You know, there's no pocket pivot here, so you do have is that a 5-day? I guess that would be a 5-day here, but I mean, I know someone I know, and you know him too, Scotty. JT are his initials. Not sure if he's on this webinar, but the other day I think he bought this one on the move through this low, up through this low. So that's 1585 right here. And so when you get the undercut and rally at that point right here, you could buy the stock and then use it as your stop, and you're up, you know, a decent amount. But this is kind of early, and I wouldn't be surprised if it came back. This ends up being your true low, because this is the first day of trading. So, I mean, that's a good trick, and it worked for a trade, but it's not clear to me that it's necessarily going to work for anything more than that, and the stock may need more time to base. Does this thing have decent earnings or anything, or is it just a...
In the last several quarters,
2%.
I mean,
yeah, that's not too bad. I don't know what the estimates are. I mean,
last quarter was good, and the sales were good, but was quite erratic on this. A little bit strange.
Yeah, maybe, I don't know. It's maybe one to keep an eye on. But I would think that this low that it formed under 1550 is going to be the one to watch as a reference low in any base that it forms, especially if the market starts to come off. So I don't know. My feeling is the market's going to come off, so I'm taking profits and just on an active basis and moving to cash or the short side, even though that's not really that easy. That's been very difficult. Like, look at Alaska Airlines. This one is one I was shorting the other day on the rally into the 50-day line, but it didn't stop, so that's a cover. And it goes a little higher and actually posts a pocket pivot. Now, this is what I'm talking about. This is remember I was talking about this with Weibo earlier and Splunk, in which we're showing these sort of comeback roundabout type pocket pivots. But it does this pocket pivot and then it just reverses the next day. So usually what happens is if I'm shorting it, I'll just go away, and if it breaks the 50-day again, I'll come back after it. Now it's starting to work as a short. Maybe it heads lower, but that just shows you how difficult the short side is as well as the long side. And even when things work, it's always a bit difficult to deal with. So, but that's one idea I've been working. We know that NVIDIA is holding tight with volume drying up, which looks constructive, So this has been on a short watch list, but it would have to bust a 50-day on some volume. Boom, we want to see some volume for that to become a short again. And it could, but it could also just set up and go higher. So it's sort of in flux, although I tend to lean towards the long side of this right now until I see a volume breach of the 20, not the 20-day, but the 50-day. And the other thing here that gives you a little bit of a clue that it really doesn't want to sell off is the fact that on Monday it had a nice shakeout. Volume picked up a little bit, so nobody really wanted to sell it, So it looked okay there. So, and it looks like it might want to go higher if the market holds up. So something to keep an eye on. And that would certainly fake everybody out because I think short interest increased by 22% over the last reported period. And the ones that have really worked would have been like the Berry Plastics, which has come down. That was shortable up around the 50-day moving average a couple weeks ago, and I think we talked about it, and it's come lower. It's out of position. X is crazy. It's rallying up to the 10-day line. Maybe it becomes shortable in here somewhere. I don't know. We'll see. Someone said they got stopped out of the Berry. Well, how would you? I don't... Because it went above the 50-day line. I think one of the things on the short side you need to do is you need to be willing to come back to stocks even after you're like, for example, I was stopped out of ALK on the move above the 50-day line on Tuesday, okay? But then I can come right back after it at the 59. So just because I get stopped out once doesn't mean I'm stopped out for good. I come back after it. So if in the case with Berry, you had been using the 50-day line here as a stop and you're putting it out here and here and you get stopped, okay, but if it comes and breaks the 50-day line again, then you could come after it again. And that's one of the things you have to do to be successful on the short side is be willing to get stopped out and then come back and short the stock again if it breaks down. So, and a lot of these take some time. They're very persistent because, this thing has 3 rallies into the 50-day line before it finally breaks. So sometimes if you're looking at the first rally as shortable, you might get a little break, but that becomes a tactical short so that you're covering and taking a quick profit. Here you test this low, you undercut this low, and then you rally back. So, I'll work these on a very short time frame until I get some decent break, and then maybe you could sit with it. Now you're in a bear flag. It could rally back into the 10-day or the 20-day. That's a possibility, but we'll see. But again, just because you get stopped out once doesn't mean you can't come back after it, and you have to be willing to do so if you're going to be successful on the short side. If you're taking it as a one-shot deal, then you can get stopped out, and that'll be it. So anyways, that's all I have, and that will conclude today's webinar. So anyways, thanks for showing up, everybody, and we'll catch you next week. Have a great weekend. I think next week we'll be doing our webinar on Tuesday because I'm actually heading up to do some R&R and golfing up at Pebble Beach for a few days at the end of the week and during the weekend. So we'll probably get the webinar out of the way on Tuesday, and that may work out pretty well because we may start getting some things developing over that time frame. Anyways, on that note, you guys, thanks for showing up. We'll catch you next week. Take care.
So long, everyone.